Hey, and welcome back. So today we're going to start talking about Chapter 5, and there'll be several pieces of these lectures. I'll keep them all to around 30 minutes or a little less. Um, and so we finished pretty much with the structure of financial accounting, how financial statements are prepared, how they're um, what the rules are for financial accounting. So we're halfway through the course. We finished with the financial accounting portion. We're now going to start looking at capital structure and some of the management or managerial accounting tools as well. But we're going to start out with capital structure. So where do we get money? Where does the money come from to um, run an organization? Every organization needs resources. You can't run an organization without resources, and those resources have to come from somewhere. And all organizations that operate in the United States, whether they're for-profit, not-for-profit organizations, all run on what we call a capitalistic system. So they have capital, and that capital is used to acquire the resources necessary to do whatever their mission is, you know, whether it's making widgets or educating students or treating patients or doesn't matter. All of them need capital, and we're going to look at the kinds of capital that are out there, where it comes from, and the structures of the various organizations um, that we have in the United States. So that's kind of our structure here. So first of all, what is capital? It's the resources needed to acquire assets necessary for the operation of a business. Pretty simple. We have to have resources to operate our business. We have to, if we're a shipping company, we have to own ships. If we're a transportation delivery company, we have to own trucks. If we're a railroad, we have to own a rail bed and locomotives and rail cars. So we need to have those resources in order to operate our business, and that is what we call capital. So the capital necessary to get the stuff you need to do whatever it is you're trying to do. Kind of a simple concept. Um, in terms of financial statements, the capital structure is always on the right-hand side of the balance sheet. So liabilities, things we owe to other people, and equity, the money that investors have contributed to the organization. And that structure of capital is really a very important concept. And we're going to spend a lot of time in the second half of this course looking at capital structure and looking at how you can manipulate capital structure. Now, you just did some um, analysis of some companies, and one of those companies was borrowing money to buy back um, their own stock. So they were increasing their debt and decreasing their equity. So increasing liabilities, decreasing equity. Why would a company do that? What's that all about? We're going to spend a lot of time thinking about that and what that does to all sorts of structures within a company. Um, we'll talk about that later, but that's an important thing to understand. So how finance can adjust capital structure, and when you adjust capital structure, how you change results, you change risk, and how you change reward. So small businesses can be organized in a lot of different ways. They can be organized as sole proprietorships or partnerships. Sole proprietorships or partnerships are not separable from their owners. So a sole proprietor is the business. To form a sole proprietorship, all we have to do is say, we're in business. I'm going to be a lawnmower. I'm going to mow lawns for other people. I'm now a sole proprietor. So we've got Shaughnessy Lawn Mowing is now a sole proprietor. A partnership is, let's say, um, Christina in the class and Mark decide to form a lawn mowing company together, but we don't incorporate, we stay as a partnership. So now we're each owners, And there is no difference between the partnership and us. There's no defining line between the partnership and Christina and Mark. We're mowing lawns together. We may have a structure that bills and receives money, and we may have an agreement as to how we share revenues and how much capital each of us is putting in. But in terms of the public, we're both our personal finance and our business finance is exactly the same. So what this means is there's no separation between a sole proprietor or a partner and their entity. So anything that the partnership owes, any liability that the partnership has, is a liability for the partners, not just for the business assets. So if I go out and I'm Christina's partner, and while I'm mowing lawns, I injure one of my customer's cats with my lawnmower, and that customer decides to sue me because their cat was their companion and meant so much to them. They can sue me. They can sue Christina, and whoever happens to have the deepest pockets will have to pay. It doesn't matter how many assets the lawn mowing company has. It's my assets and Christina's assets that are at risk. So there's no difference between our personal assets, our houses, our cars, or whatever we have, and the entity. So that's a sole proprietorship or partnership. They require no special filings. You can form a partnership or sole proprietorship just by saying I am one. Then there are three other kinds of organizations, all of which are corporate. There's a limited liability corporation. We'll talk a little bit about that later. Sub-S corporation, another type of corporation allowed to be formed under the IRS code. And then a subchapter C corporation, which is a standard corporation. So most of the larger companies you know about are C corps. They are separate entities in all cases. And then if you take that same lawn mowing company, if Christina and I had formed an LLC or a sub-S or a C, and I had injured a cat, the injured party could have sued the entity, the corporation, and could have recovered against the corporation as much as the assets of the corporation are, but they couldn't have gone after my house or my car or my firstborn child or whatever. They can't pierce that. So the corporation is a separate entity, legal entity, and is the only organization that can be sought after by people who have a claim, a liability, something that's owed to them. For small businesses, the capital usually comes from family, friends, or banks, or it's internally earned, so it comes from the earnings of the company. So the initial capital will come from family, friends, or banks, and then the company, if it's successful and generates earnings, may retain that capital and retain those earnings and increase their capital. Some small businesses may access what are called private equity funds. It's groups of investors who put money together to invest in startups or small businesses. And sometimes venture capitalists also provide funding for small businesses, startup businesses. Depends on where you are and what kind of business. You're probably not going to find a private equity fund or a venture capitalist to fund your lawn mowing business. But if you've got some kind of a new invention or a new concept like Uber or some kind of a medical device or something like that, you may be able to find a venture capitalist or private equity fund to provide your capital. Not-for-profit organizations really follow the same thing, but their initial capital usually comes from donations. So, and sometimes follow-on capital as well comes from donations. Not-for-profit organizations also borrow money, so they get some of their capital from debt. And once established, once again, not-for-profit organizations can use the money that they generate to increase their capital. We don't call it earnings when it's a not-for-profit. We call it net revenue. But it's the same thing. It's the revenue minus expenses for a not-for-profit. If that's a positive number, if revenue is greater than expenses, then you end up with net revenue. In a for-profit situation, revenue minus expenses equals net profit. There really is no difference between net profit and net revenue. It's just terminology. Add that and the fact that not-for-profits don't pay taxes on their net revenue, and for-profit organizations do. But either way, that net revenue or that net profit can be retained within the organization and used to increase capital. For-profit corporations, corporations, first of all, provide limited liability, which we talked about a few minutes ago. Limited liability means that organizations their owners are not liable for any more than their investment. So if an owner has invested in a corporation, they can lose their whole investment, but they can't lose more than that. And that's a big, important thing to understand. Corporations came into being in the Netherlands and in England when the first large trading corporations were founded, the East India Trading Company and companies like that, which owned lots of ships that traded with Far East. And it was a highly risky business. So these organizations owned lots of ships. They had small private armies and other things, private navies, private armies to defend their ships. Big organizations, but with very risky. A lot of these ships never returned. When they did return, they had very, very high profits for the goods, the spices and so forth that they were bringing back to Europe. So it became necessary to find more capital than an individual could put together, and people who were providing that capital didn't want to risk losing more than they were investing. They didn't want to be liable for other things that they didn't know about. They only wanted to be liable for their investment. So that's where the corporate form came from, and it is the primary form for almost all business organizations worldwide, really, other than in socialist countries where the government owns and provides capital for organizations. So the corporations have limited liability. Owners can buy and sell shares, and it doesn't have any effect on the corporation. So once a company has issued shares, let's say I own 1,000 shares in Microsoft, when I sell those shares, Microsoft doesn't care. It doesn't affect them. When they initially issued the shares, they received the investment for whoever bought those initial shares. But when they get traded in the marketplace, it doesn't have any effect on Microsoft. The fact that I own 1,000 shares and I sell them to Binner, who now owns those 1,000 shares, they're going to pay the dividends to somebody different, but they don't care. It doesn't affect their balance sheet. They still have the money that was initially invested. They still have shareholders. So no effect on the corporation when owners buy and sell shares, which is good, because in a partnership, when I sell my partnership interest to someone else, let's say Christina and I are still running our lawn mowing business, and I decide to sell my partnership interest to Joe Clancy, that affects Christina greatly, because now the partners have management responsibility, and now Christina has to work with somebody new, and maybe she doesn't want to work with Joe. Maybe they're incompatible. So that's a big difference between a corporation and a partnership. So buying and selling shares outside of the corporation is easier, which makes them more liquid, which makes them more desirable. You can sell shares easier than you can sell partnership interests. The only risk is the amount that you have invested. You can certainly lose all of that, but you can't lose more than that. So I can invest in Tidewater. Tidewater declares bankruptcy. My stock becomes worth zero, but they can't take my house to pay the debts of Tidewater. They can only take what I've invested, and that's a good thing. It at least limits my liability. So for-profit corporations get financing by selling stock, so that's equity financing, borrowing money, that's debt financing, or retaining earnings, which we call internal financing. So those are the three ways that capital is acquired by for-profit corporations. And most for-profit corporations do all three. They have a mix of capital that comes from equity, selling stock, debt, borrowing money, and internal financing, retaining earnings. So you'll see in most corporations, you'll see all three of those ways for acquiring capital. So when we sell stock, generally we sell what's called common stock. And common stock is a ownership share in the company. So each common stockholder owns a proportional share of the corporation's assets. So if the company has 100 shares outstanding and I own 10 of them, I am a 10% owner of the company. I own 10/100ths. If the company has 10 million shares and I own 10 of them, I have a 10/10,000,000th share of ownership in the company. So that's how common stock works. If you own common stock in any company, you are a proportional owner. You have the right to vote your shares to elect the board of directors. So as a common stockholder, you have a vote. And it's not one man, one vote like when we vote for political office. It is one share, one vote. So if I have 1,000 shares and you have 100 shares, I have 1,000 votes and you have 100 votes. So it's proportional to how much I own. If I own 50% or more of a corporation, I can control the board of directors. I can vote my board in. If I own anything less than 50%, I have to get other shareholders to agree to vote for my directors, the people I want as directors. So that's how voting works. And the board of directors is the organizational and the part of the company that runs the business. They hire managers. Managers run the business, but the managers report to the board, and the board is the representative of the stockholders. If you own common stock, you're entitled to a proportionate share. You're 10 out of 100 if you own 10 shares out of 100 of any distribution. So if the company pays dividends, you will get a proportionate share of the dividends. If the company liquidates, sells all their assets and returns the capital to the stockholders, you will get your proportionate share from liquidation. We already talked about the fact that common stockholders can sell their ownership interest and it has no impact on the corporation, and it's limited liability to the amount of the investors. The investment returns for common shareholders are dividends, so money that's returned by the company, the corporation, to the shareholders, and any increases in the value of the stock. So stock prices increase when the company does well. So if the company's earning more money, the value of the stock goes up because it has each share of stock has a larger portion of the overall earnings. So if the company was making $1 million and the earnings go up to $2 million, each share has a share in $2 million as opposed to a share in $1 million of earnings. So presumably the shares would double in value. Not always, but that would be the basic presumption. So those are the two ways that common stockholders get investment returns. That's why they invest. They invest to have a return. Companies issue common stock in different ways. So when it's a newly public company, they do what's called IPOs, which is an initial public offering. So we've never been public before. We decide to go public. We have an IPO, first public offering. Now we already have shareholders. We've been private to this point. We have people who own shares, but they have decided to go public and they issue stock to the public called an IPO. And various companies in the recent past have done that. Facebook has done it. Uber is not. Uber has not issued stock yet. They're still privately held. I'm trying to think of some other companies that nothing's coming to mind right off the top of my head, but many companies have gone public recently. and they do IPOs. Companies also sometimes issue stock to pay for new acquisitions. So they may sell additional stock and use the proceeds of that selling of additional stock to buy some other company. And then companies also may raise additional capital, doesn't happen as often, simply to have additional capital. The reason that doesn't happen as often is the more shares you sell, the shares that are already outstanding, their value is diluted. So let's say we had 100 shares and you own 10 of them, you own 10%, and we decide to sell another 100 shares and we have 200 shares, you still have 10 shares, so now you only own 5% of the company. That's what's called dilution. Stockholders generally don't like dilution because they owned 10% before and now they only own 5%. So generally, unless the company has invested that additional money that they raised extremely well, the value per share will fall. So that's dilutive and doesn't happen as often, but it does happen. Companies get into situations where they need more capital. After the 2007-8 crash, financial firms all had to raise more capital. So banks and insurance companies and so forth. So they all sold additional shares, diluting the ownership share of their existing stockholders. They had to do that because the regulators said you have to have more capital in order to be safe in the event of another crash. So you need more capital and less debt. So they all sold additional stock to raise capital. And then finally, companies issue common stock to employees as part of employee compensation plans. So many companies pay their shareholders with stock option plans. So it's a benefit. Some of you may have them in some of the companies you work for. So you work a certain amount of years, or your contract gives you the right to receive corporate shares, and then if the company does well, those corporate shares also obviously increase in value. Dividends. A lot of confusion about dividends amongst non-financial people, but dividends are never required to be paid. They are voted on by the board of directors. It's a return of capital to stockholders. So the stockholders have given me capital. The board of directors can vote to return that capital to stockholders by paying dividends. Many companies pay dividends very regularly, but you can't assume that because a company has paid dividends in the past, they will continue to pay dividends, because it is voted on. Every time a dividend is paid, it's voted by the board of directors. And if they choose not to pay dividends, then they don't. And that happens. General Electric is a good example. They paid dividends from 1930 every quarter until 2008. And not only did they pay dividends every quarter, but their dividend went up. The dividend per share went up every year from 1930 to 2008. 2008, they didn't pay any dividends. In 2009, they didn't pay any dividends. They started paying dividends at a lower rate back in 2010. And the reason they didn't pay dividends is they were conserving capital because they thought the whole company might die, go into bankruptcy, based on the financial crash, because they had a huge financial division in General Electric that suffered greatly in the financial crash, and they needed the capital. So they said, well, we can't pay dividends if we don't have enough capital. We need to protect the company, so we're going to stop paying dividends. So if you bought General Electric shares on the historical record that they always pay dividends, they don't always pay dividends. So dividends are paid to people, to shareholders of record. So when dividends are declared by the board of directors, there's a declaration date. At that point in time, they become a liability for the company. They are required to be paid, so they show up as a liability, dividends payable on the balance sheet. So the date they're declared, that becomes a liability, and the company shows it on its balance sheet as a liability, and it reduces retained earnings by the amount of the dividend. So declaration date, we credit dividends payable and we debit retained earnings by the amount of the total amount of the dividend. Then when they're declared, the board of directors says we're going to pay dividends to shareholders of record on such and such a date. So if we're declaring dividends on, let's say, August 31st, we may say for shareholders of record on September 30th. And then finally, we say we will actually pay the dividends on October 15th. So 3 dates: declaration date, record date, distribution date. There's never a requirement for dividends until the declaration date, and then it becomes a legal responsibility. Once they've declared dividends, they have to pay them. And it is a return of capital to shareholders. For C corporations, most large corporations that you might buy stock in are C corporations, there is double taxation on dividends. So the corporation pays tax on their earnings at the corporate level. They pay dividends, and dividends are not a deductible expense. So they pay dividends to their shareholders, not deductible. It's not an expense, actually, it's a return of capital. And then the recipient, when you receive your dividend, you are taxed on it. So there's tax on the earnings, and then when it's distributed to the shareholders, it's taxed again. So it's called double taxation. So let's say the corporation pays 35% tax, then let's say they make $100, they now have a 35% tax, so their net income after tax is $65. They pay $50 out in dividends, and then their shareholders would pay an income tax on that $50 they received as a dividend. So there is a double taxation there. There are ways to avoid double taxation, and many smaller companies do, not very many large companies, but many smaller companies avoid the double taxation by choosing to become an LLC, a limited liability corporation, or a subchapter S corporation. I'm not going to go into the details of the arcane tax details of the difference between LLCs and sub S's, but they both allow for income to be taxed directly to the owners, as opposed to being taxed at the corporate level and then taxed again as a dividend. So if you own an LLC or a sub S, you pay tax on the earnings of the corporation, your proportionate share of the earnings of the corporation, when the company earns it, whether you receive it or not. So if you leave the money in the corporation, it's already tax paid. You pay the taxes on your personal income tax return, whether the company distributes the money to you or not. So that's how sub S's and LLCs work. And they're very, very popular and common, especially in privately held organizations. So if you want to form your own business, you probably are going to set it up as an LLC or a sub S, because it allows you to avoid that double taxation that happens. Not as popular with large corporations, because let's say you owned Microsoft. And Microsoft, the earnings attributable to your shares were, whatever shares you owned were $100,000. That $100,000 would show up you'd have to report that on your tax return, even if Microsoft didn't pay you dividends, didn't return some of that capital to you. So now you've got $100,000 of income and no money to pay the taxes on it. So that's the downside of these things, is that the potential for a mismatch between what income you report and the resources to pay that income tax are sometimes a problem. So I know in the companies that I ran, most of them were LLCs. I had a couple of sub S's as well. As an owner, I would pay taxes on the entire earnings of the company, and I would make sure that I distributed enough funds to myself to pay the taxes. I might not take any more out, but I would take out enough to pay the taxes, so that I didn't end up in a net negative position personally. So dividends, growth companies often don't pay dividends. So young, fast-growing companies often retain all of their earnings rather than paying dividends because they need the capital and they can invest the capital profitably. They can invest the capital at a high rate of return because they've got lots of growth opportunities. Stable companies, what the stock market sometimes calls blue chips, tend to pay dividends regularly, and they tend to pay higher dividends. So two different kinds of companies. Dividends, some investors like dividends because it provides a steady stream of income. Other investors don't like dividends because they have to pay taxes on it. And they'd rather see the value of their stock holding go up, which is tax-free growth until you sell it, as opposed to receiving dividends that you have to pay taxes on. So two different kinds, and it's the decision of the board of directors in either case as to whether to pay those. So when we retain earnings, we hopefully invest those earnings in operations of the corporation. And obviously, if the investments are valuable, that works well. If we have good investment opportunities and can earn a good return on our investments, that's a good thing. If a company doesn't pay dividends but can earn a high return on its investments, those stockholders who need cash can sell some of their stock, and their stock will have appreciated because the company is doing well. They're reinvesting their earnings, they're making a lot of money, their earnings are growing, and therefore this value of their stock is growing. So if you need cash, you can sell some of your stock. Stockholders who don't need the cash can choose not to sell, and they have increased value and no taxation until they sell their stock. So that's the advantage of growth. You don't end up with a tax bill until such time as you sell the stock. The advantage of dividends: steady, dependable flow of income. Retired people often like dividends because they can count on their dividends, or sort of count on them. They're not guaranteed, but count on the fact that every quarter I'm going to receive a dividend check from my investments, and that money will be able to help me live. It is taxed to the recipient. It is taxed at a lower rate than interest income, so there's a preferential tax rate on dividend income. Depending on what bracket you're in, it ranges from about 15% to 22%, whereas ordinary income ranges from 10, well, if you're low income, there's no tax on dividends, but regular income ranges from 10% to 39%. So the highest rate on dividend income is about 22%. So there's an advantage at slightly lower tax level. If your stock is held in an IRA or 401k, then the dividends are tax-free. They don't get taxed until such time as you retire and start drawing income from your IRA or 401k. So dividends flow in tax-free into your IRAs and 401ks. And dividends are often paid by companies that can't invest their earnings at a high enough rate of return. So if they're in an industry where they're mature industry where there's not many growth opportunities, they often pay higher dividends than companies in growth areas. When you're investing in stock, your investment return is the dividends that you receive plus or minus the appreciation or depreciation of the stock value. So if I have a stock that I bought for $10 and it pays $1 a year in dividends, then I have a 10% return, $1 a year on my $10 investment in dividends. And let's say the stock appreciates to $11, now I have a 20% return. So the stock value went up by $1 and I received $1 of dividends. So therefore my return, my total return, is $20. Let's stop there. We'll ask you a few questions after this, and then we'll go on to the next part of this lecture. Thanks for listening, and I'll see you soon.